What's up everybody? GenExDividendInvestor here. In this video I'm going to show you how different amounts of dividend yield and dividend growth rates impact how long it takes you to make back your original investment purely from dividends. I put all that information in a free spreadsheet that anyone can make a copy of. So if you appreciate videos like this as well as free stuff and you aren't Hans Landa, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Note, I'm not a professional wealth manager, so don't take anything I say as financial advice. So I use Fidelity as my main brokerage for my dividend portfolio, and they published an article called Why Dividends Matter, and I want to share an important paragraph from it. They said, quote, "Dividend-paying stocks provide a way for investors to get paid during rocky market periods when capital gains are hard to achieve. They provide a nice hedge against inflation, especially when they grow over time. They are tax-advantaged, unlike other forms of income such as interest on fixed income investments. Dividend-paying stocks, on average, tend to be less volatile than non-dividend-paying stocks. And a dividend stream, especially when reinvested to take advantage of the power of compounding, can help build tremendous wealth over time." End quote. I can attest to what they wrote, speaking as someone who was able to retire early, aka FIRE, because of dividends. Now, in that article they showed a chart called the Dividend Payback Matrix. It piqued my curiosity because The Matrix is my favorite movie of all time, and because on December 22nd, The Matrix 4, aka Matrix Resurrections, is being simultaneously released on HBO Max as well as in theaters. I'm super excited to see where they take this new Matrix, and I'm hopeful that they can do better than the last two movies. Anyways, the chart tells you how many years it would take you to make your original investment back purely from dividends, based on various starting yield percentages and dividend growth percentages. Let me share another relevant part of the article. It said, quote, "A stock's capital gains potential is influenced significantly by what the market does in a given year. Stocks can buck a downward market, but most don't. On the other hand, dividends are usually paid whether the broad market is up or down. The dependability of dividends is a big reason to consider dividends when buying a stock. Not every stock must pay a dividend, but a steady, dependable dividend stream provides nice ballast to a portfolio's return. For example, Procter & Gamble, the consumer products giant, has paid a dividend every year since 1891. Procter & Gamble's stock price has not risen every year since 1891, but shareholders who owned the stock at least got paid during those down years. They weren't totally dependent on capital gains to get paid." End quote. Do you get how cool that is? Procter & Gamble, which is the 6th largest position in my dividend portfolio, has been paying dividends to its shareholders every year for over a century. They've paid dividends through the stock market crash of 1929 and through the ensuing Great Depression, through World War I, World War II, and beyond. Even more crazy is that they have been increasing their dividend for the last 65 consecutive years. So while I know dividends aren't a guarantee, having a portfolio of 26 decent dividend stocks made me feel comfortable enough in the reliability of their income that I quit my job in my 40s and have been using dividends to pay all my bills. It still blows my mind knowing that my mortgage is being paid 100% by my dividends, especially knowing that my portfolio's average rate of dividend hikes has been around 8% a year, and my mortgage is fixed. So today's high inflation rate of 6% to 7% is still under how much my dividends go up on average. Okay, back to the chart. The top row has dividend yield percentages, and the first column are the various dividend growth rate percentages, aka CAGRs. So let's say you bought a stock which had a 4% yield. That puts us in the 4% yield column. Then if that stock had an 8% dividend CAGR, we see that it would take you 14 years of dividend payments to get your original investment back to you. Now let's pretend we bought one share of a stock that cost $100 and that paid a dividend of $1 every quarter, which is $4 a year, which means its yield is 4%. So in 1 year we would get $4 of dividends for that single share we bought. Assuming an 8% dividend growth rate means they would increase their dividend by 8% for year 2, which means they would pay out $4.32. Then in year 3 it increases 8% again, which means it would pay out $4.67. And if they kept increasing that payout by 8% a year, then when we hit year 13 they would be paying out $10.07 a year, and finally in year 14 they would pay out $10.88 per year. And if we add up all 14 years of those dividend payments, then we would get to just under $100 that they've paid to us, which was the original investment. So you need 14 point something years, or 15 full years of dividend payments to make back your original investment, using a stock that had a 4% starting yield along with an 8% dividend CAGR. Thus, it looks like Fidelity rounded down the numbers, even though I'd argue it's more accurate to round up. Still, their table was helpful, but I thought I could improve on it and give you more value if I created a free spreadsheet that allowed you to input any amount with a dividend yield and a dividend CAGR so that you could see how all the numbers interact, and I would round up rather than round down to more accurately reflect the full number of years it would take. To make your own personal copy of this spreadsheet, all you need to do is log into a Google account and then click on the link in the description of this video or in the pinned comment, and then go up to the File menu and click Make a Copy, and then name your spreadsheet whatever you want and click OK. Voila, you will have your own private copy on your personal Google Drive that you can bookmark and then do whatever you want with. So let's jump into it. Okay, so here we are in it, and this top area is just some static data, basically from the fidelity matrix, just updated a bit based on rounding up rather than down. So for example, if your portfolio's average weighted yield was 4%, or if a particular stock was, because either would work, and then let's say your CAGR for that stock or your portfolio's average weighted CAGR was 8%, then you can see it would take 15 years for your investment to return back to you in dividends. So down here though is where you can put in your own amount. So if you scroll down a little bit, there's basically three things you can put in: a starting amount, a dividend yield, and a CAGR. In this case, I put in $100, 4%, and 8% CAGR. And then there's 100 rows of data that you can kind of scroll through if you want to look through how things change. But basically, we've got your yield on cost, your divs per year that you get, your ending yield for that year, and total dividends paid. So for example, if your portfolio or a particular stock was $100 and you had a 4% yield, 8% CAGR, then basically you want to figure out how long it would take for you to get back to $100, and you can see around between year 14 and year 15 when the total divs paid hit that $100 that you'd get the money back. So for example, you could come here and say, maybe I have a $5,000 portfolio and it's a 4.2% yield, and let's say it has a 12.5% CAGR, and then you can see, okay, how long will it take for me to get $5,000 in dividends? And you can see that it would take you about between year 11 and year 12, because that's when your total hits these two amounts. And that's how you can use this tool. Note, this doesn't call out any additional potential returns from stock appreciation, nor does it include how things would change if you were reinvesting your dividends in a drip, nor does it factor in taxes or inflation. But it is a nice way to gain an understanding of starting yield relative to CAGR to see how many years it would take you to get back your original investment just from dividends. Anyways, in this example at year 14, we see that they pay out $10.88, which means your yield on cost would be 10.88%, since yield on cost is your current dividends paid out per share per year, divided by your original cost basis per share. And in this case, we're effectively modeling one share, though you could extrapolate this to being your portfolio averages. Looking at the chart, we can see how a high 5% yield stock with a low 3% dividend CAGR would take you 16 years of dividends to get back your original investment, which is the same as a 3% yield stock with a 10% CAGR. Now, a key point that the article had was that you shouldn't invest in stocks that only have the quickest payback, because total returns matter more. Like, it's great to have a stock pay back your initial investment in, let's say, 15 years, but it's better to own a stock that increases your initial investment 5-fold in 15 years. Though as always there are trade-offs, and in some cases you might want to buy a quality company that is more of a total return stock, and in other cases you might be okay to sacrifice some total return in favor of income now or a quick payback. Regardless, understanding dividend payback is a worthwhile concept for framing the risk-return potential of stocks, and to see how different starting yields and dividend CAGRs relate to the amount of dividends you're getting. I personally find it helpful to build my portfolio based on my current needs along with my anticipated future needs, factoring in a variety of things like dividend yield, growth, sector composition and weighting, confidence in my companies and their industries, etc. So this sort of information I find useful. This spreadsheet reminds me a bit of what's called the rule of 72 in investing, which is a simple way to determine how long an investment will take to double given a fixed rate of return. What you do is divide 72 by the annual rate of return to get an estimate of how many years it will take for your investment to double. The rule of 72 assumes compounding, so it grows faster than the spreadsheet where I didn't include the compounding effect of dripping. Okay, let's say you were getting a 9% annualized return on your portfolio. The rule of 72 says that it would take you 8 years for your investment to double. Or that at a 5% annualized return, your investment would double in 14.4 years. It's fun to estimate how long things will take to double, because you're probably only a few doubles away from that proverbial million. For example, let's say your portfolio is worth 75 grand. 1 double takes you to 150 grand. 2 doubles takes you to 300 grand. 3 doubles takes you to 600 grand. And 4 doubles takes you to 1.2 million. So you are only 4 doubles away from being a millionaire. So if your portfolio is averaging a 9% return, and 8 years is how long it will take your portfolio to double, then it would take you about 8 years times 4 doubles, which is 32 years to grow your portfolio to 1.2 million. Think of your portfolio in terms of doubles. It's very motivating. Speaking of portfolios, I want to mention that M1 has a special $50 referral bonus when new people open a brokerage account per their requirements. The way it works is you click on my M1 referral link in the description of this video and then either open a brokerage account and fund it with $100 or open a retirement account and fund it with $500. Deposits which need to happen within 30 days of you opening the account. Then you need to keep your initial deposit inside the new account for 30 days from the date of deposit to get the free $50. This promotion runs until 2022, at which point I'm guessing they'll probably still offer some sign-up bonus. It's basically free money, so consider starting that new growth or dividend portfolio that you've been thinking about. Okay, now I'd like to shout out my latest Patreon aristocrat who just signed up. So thank you, Chill. Aristocrats gain access to my dividend portfolio tracker spreadsheet, along with access to multiple private channels on my Dividend Discord, including one where I let people watch my videos before I release them to the public, as well as I often let you vote on which thumbnails I use for my new videos. I recommend that everyone join my free Dividend Discord chat server, which has thousands of people on it from around the world. Finally, if you appreciate free videos like this and you aren't Agent Smith, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Thanks for watching and clicking the like button. Stay positive and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.